Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of Lifetime Cash Flow. I'm Khleif, and I am thrilled you're here, and I know you're going to get tremendous value from the gentleman I'm interviewing today. He's someone I met at an industry conference. You know, anybody in the business knows you have to go to industry conferences. This is how, this business is really not as much what you know as who you know, candidly. And I tell my students, my warriors, this all the time. Focus more on the relationships even than learning the business, because it is that freaking important. And his name is Chad Sutton. He's the one of the managing partners of Quattro Capital. They've been involved in 2,300 doors. Really sharp guy, and I'm excited. Oh, and also, I was on his podcast called Real Estate Runway. In fact, it just dropped a day or two ago, or it's about to drop or something. But anyway, we're going to have a wide-ranging, very much more deep conversation than I think you're used to. So buckle up. Welcome, brother.
Hey, good to see you again.
Yeah, likewise, my friend, likewise. So, let's start the way we normally do, just having you tell a little bit of your background and, why real estate, where you came from, and all of that.
Yeah, I love going through this, and how much time do you have is the real question.
Right, yeah, no, more high level, but maybe you could speak to, when you're giving us your bio here, just maybe speak to at what point you had the epiphany,
Yes.
Okay, all right.
I remember the day and the time. So look, y'all, I didn't grow up in any major means or anything like that. I didn't go to Harvard. I wasn't a Wall Street guy. I grew up just like everybody else. I was a, middle-income child. I was parented by a single mother for a long time until she met my father at age 5. So I lived with my grandparents, got a very special relationship with them. But look, I was always the kid tinkering with erector sets and connects and Legos and stuff like that. And so, and I showed to be pretty good with numbers in school. So the world told me I should be an engineer. And guess what? I listened. I went to college, got a great engineering degree, went to work for NASA for a little bit when the space shuttle was still flying, dated myself a little bit.
Cool.
And, spent the rest of my career with General Electric in aircraft engine design. So I did a lot of really cool stuff. I designed smoke and fire, combustion. I have patents. I put us in billion-dollar technology arenas. It was amazing, until I looked to my left one day and I looked to my right one day. I looked at my senior engineer on my left and my principal engineer on my right, and I was like, you know what? I am so specialized that I can work for literally one of 3 companies in the world, and I already work for one of them. And it was a very rude awakening that I'm kind of pigeonholed here. And around the same time, you might remember GE went into an interesting time where
I love the stories about GE with Mike. Was it Neutron? You know who I'm talking about, the CEO that fired people.
We have everything from Jack Welch.
Oh, Jack Welch, Neutron
yes.
Jack. Yeah, that's what I was talking about. His books are fantastic.
They are, but this was past the Neutron phase, and this is in the MLT phase when we really experienced a $50 stock price share down to a 5 in about a year time frame. So it was a rough time. I got plucked, and I went into...
What do you mean?
I got plucked from my engineering desk.
Okay.
And they put this team in place, and it was a fantastic opportunity. Global consulting, like basically think about a KPMG or a
got it. Like a big accounting firm,
right? But we made an internal team, and the credentials were you had to know how to design product, manufacture product, and know a little bit about business. And so I got to fly.
What was the outcome
world.
For this team?
Variable cost productivity. The whole idea was how do we make our big industrial products slightly cheaper but still have the same outcome. Right. Okay. So it was balance sheet. It was how do we lower variable cost across the enterprise.
Gotcha.
So, and the reason this is relevant, Rod, is I flew around the world on the company's Amex for 3 years, going to every GE facility you can imagine, like everything from Zipf, Austria, to Shenyang, China, to Oslo, Norway. It was amazing. So I got a couple of things out of this. I learned how to manage a P&L. At very large levels.
Right.
I learned how to negotiate and initiate culture change internationally. Imagine a 20-something-year-old kid coming into a factory in Oslo, Norway, and telling a bunch of guys who've been doing something one way for 50 years how to change it, right?
I want to dig into that a little bit more, but
yeah,
I that's a topic I enjoy. But keep going, please.
So I got some skills out of that. Well, that led to an executive role where I was in charge of national supply chain purchase for the renewables business for a long time. And why is this relevant? let's pause that story. So now I'm an executive with GE. I am, my whole job is to take everything from my suppliers and as the big spend GE, get the cost out, margins down.
Beat them up as much as you can.
I was good at it, Rod. I was really good at it, okay? So I started to feel a little bit despicable. Meanwhile, I've seen that I've created technologies, I've got patents, and all I got every year was an attaboy, smack on the butt, and a 3 to 5% raise, right? So I'm doing all this amazing stuff, making about $1.50 a year. You think you're on top of the world, right? You're starting to realize.
When was this?
This was in. I actually officially left the company in 2020. So this was from.
Oh wow, this is recent.
Yes.
Wow.
Yes. Not that
so
long
you did
ago.
all this real estate stuff in really the last 3 years.
Well, concurrently, there was some overlap. We'll get to that.
Okay, fair enough.
So let's back the story up to 2016 for a second, because we're going to get to the end of these parallel paths where they culminate. 2016, I mentioned that I lived with my grandparents growing up. Very impressionable on my life. My grandfather falls ill, okay? And I'm not going to go into the details.
2016.
In 2016. It was horrible the way he died. I was at the bedside, not as much as I wanted to because of my JOB, but I was there. And, it's hard not to get choked up in that because it was a massive, massive influence on my life. But he passes away. Grandparents had a big real estate portfolio.
Oh, really?
70 single-family homes.
Wow.
Waco, Texas. So if you remember the Chip and Joanna Gaines Fixer Upper show, my family was there before Waco was cool, you know. But thanks Chip and Joanna, they did a lot of good things for the property value. So I get involved with the business with my now business partner, who is my aunt. So
your aunt?
Yes. Little spoiler alert: 3 out of 5 partners in Quattro are family.
Oh, no kidding.
My mother and Kim, who is her sister, and my aunt, and I am the 3rd generation investor. So we have kind of 3 generations of real estate in my family. Didn't know that until I was 30, right?
Wow, I want to talk about that too.
So plenty to go into there. But now let's culminate the stories together and how I got to where I am and why this matters. I was still working, and Kim took over the family portfolio, sold about half of it, put money into the other half, and all of a sudden we tripled the value in 12 months. Cash flow is up, value is up. We're like, holy smokes, there's something to this, right? Now, Kim is a brilliant woman, billion-dollar IT project manager from Northrop Grumman and the state of Texas, brilliant woman. Okay. So did a lot of work there. And then I go try to replicate this in the state of Tennessee, right? And so I remember I'm also at the point in my career where I'm like, I'm only, look, Earl Nightingale says it best. Your rewards in life are only as high as the degree of difficulty of what you do and how hard it is to replace you. And I was starting to feel just that, because as valuable as I thought I was.
You mean replace you in your job?
Yes.
Gotcha.
I could be replaced tomorrow. Really? It doesn't matter how good I was.
Well, I disagree based on what little I know about you, but anyway, continue.
In the job I was doing.
Right.
So let's say, I mean, as smart as I was as an engineer, there's 100 other guys like me who could do it.
Okay. Okay.
So with the resources of a company behind you. So this is something to remember. So I'm realizing that. And now I see there's this path in real estate. So we're talking massive net worth, passive income, more money than I've ever made in my job. I go try to replicate it, and it falls on its face because we realize, single family real estate isn't scalable. You can't go to do that. We'll talk about that, I'm sure. You talk about that a lot. And, we couldn't quite make the rent ratios work in the state of Tennessee. So then we start researching asset classes, and I'll pause it here. Let's pause because I actually want to dig in on a couple of these things. Don't let me forget to circle back to this, though. But you talked about single family. Elaborate on that, because I want them to hear it from you instead of me, because they're like, single families are great. Yeah, well, the problem is they really don't cash flow nearly as well as multifamily. And you want to elaborate on that a little bit? Yeah, and it doesn't take long to do it, folks. I mean, in commercial real estate, you're valued on the income approach. In single family, you're primarily valued by sales comps. So it doesn't matter how well you cash flow. If someone down the street is willing to pay 2x for a place to live, that's going to set the market comps for your place, which means to buy an income property, it makes it that much harder to buy it, below value and do some good work to it. So let's just put that to the side.
So that's just one piece.
That's one piece.
Right.
Let's talk about operations. Okay. At best, and this is with 70 single-family homes, 70. At best, you're going to get the best-in-class mom-and-pop property management company. Why? Because the best-in-class folks who know how to market stuff, know how to turn stuff efficiently, know how to handle work orders, create a community, all that kind of stuff. They don't fool with stuff that is.
They don't mess with single family.
They'll mess with
no,
it.
you're going to get a broker that does it on the side.
Yes.
Or something else. You're going to have horrible management, number one.
Horrible management. It's going to cost you 3x as much to take care of the place. Because think about it. On a 100-unit complex, you have a maintenance shop and 2 guys, or at least 1 guy who's there all the time.
Right.
All you got to do is get on a golf cart, run over to the maintenance shed, get something that's
Get the parts you need because you stockpile parts.
But
right?
every house you own is different. So what's to say you're even going to have the part you need? So you probably have to call a part-time guy out there or a service vendor, which is going to charge you 30%. They're going to come out, diagnose the problem, go to Home Depot, find it, come back, probably forget something, go back and do it again, and then come back and fix the problem. So you're down a day to fix a toilet ring.
Yeah, you've heard this before, haven't you? Yeah, I'm looking at Matt.
You said that same thing before?
Exact same thing. This is why
I've seen
I don't know if you
I've
remember my story. I had 800 houses when the market here crashed.
Yeah.
Okay,
Yeah.
2 hours north of me, 2 hours south of me, everywhere in between. And the other thing you haven't mentioned is of course the maintenance kills you. And these were C-class houses in my case. So they're older, tougher demographic. They're harder on it. So we really never really cash flowed much of anything. And the other piece is, in my case here, taxes in Florida are higher, property taxes, because there's no state income tax. So they've got to make it up somewhere.
Texas is the same way.
Yeah, and that's right. That's right. And then, I had properties in wind and flood zones, so we'd have higher insurance. But the other thing people don't think about is every one of these houses has to have its own insurance policy, has its own tax bill, and comparatively, it's much less money on a multifamily asset. And so, they just don't cash flow well. They just don't. And so, and I get in arguments with single family operators online and sometimes, we actually did some guy had us do like a debate between a couple single family operators and me and another guy on the multifamily. So we kicked their asses, but it was because it just is no comparison. But
and it's 3 words, folks. It's economies of scale.
Yeah, that's it. That's it. Bottom line. So I want to circle back to a couple other things you said. So you talked about family. Have you ever had any setbacks in your operations? Just curious. With your family operation, any big setbacks?
Family, and I have, and I'll tell you, partnering with family is not for everyone, and I'll tell you that
it's dangerous.
It's dangerous, but there are members of my family that I would not partner with. From an intellectual level, from a get-alongness level, from a problem-solving level, I felt that when we started, it was just Kim and I. Tammy joined later, my mother. And I was apprehensive to let my mother join the business. When we talked about bringing her over from the family portfolio to the multifamily business, I was very hesitant. So Kim and I, we worked very well together. We're both very type A, very analytical, very strategic thinking. And when we fight, we do argue, but it's more like challenging each other. It's not personal digs at each other.
Gotcha.
So
so you have a healthy respect for each other.
Respect.
Yeah, that's critical. The thing that the reason I brought it up is when everything crashed in 2008 and 9, I had a couple of my brothers involved, and it sucked. I mean, and I don't think there was a real blame game. I mean, countries went bankrupt in 2009. Yes. Iceland went, and so, it was, but there was still animosity, and
sure.
And I remember I'm big into watches. I'd gifted my brother a Rolex, a Yachtmaster, like $40,000 watch, and I found out, and I bought myself one. I gave it to him as a gift when things were really rolling, and I found out he had to sell it just to get by, and I felt horrible. So I gave him mine, and I finally bought myself a new one, like literally 6 months ago. So anyway, I digress. But
I have to finish the comment.
Please.
So then I brought my mother into the business, and it was great. We now have a high respect for each other, but there is an innate risk in that.
Sure.
You have to make sure you have a respectful relationship, and you can separate business and work. When we go to family events, we don't talk about business.
You don't? Okay. Well, that's really good too. Well, I want to circle back to one other thing, just because for my own personal edification, because it fascinates me, because I love anything around entrepreneurship and business development.
Yeah.
So you said you went to these factories as a young punk, wet behind the ears, and what did you have to do culturally with those groups of whatever it was, inventors, factory workers, whatever it was, and at a high level, how did you accomplish any changes in culture? I'm just curious because.
This is an easy one. And folks, I never knew this was a strategy until I read a book called Flip the Script by Orrin Khleif.
Oh, that's a good book.
He was describing stuff I used to do, and I never knew this. But so read the book if you want to get some tacticals on this. But here's an example. You walk in as an American kid, not just a kid, an American kid, to countries who, for the most part, think Americans are entitled and bossy and pushy and
loud, noisy,
yeah,
irritating, right?
And he's right in our case,
right? Very often, yes.
So the number one thing you have to do is create status alignment, and that could you have.
What does that mean?
I'm going to explain it.
Okay.
You have to know how to come to a problem. So if the person you need to talk to is here, do you come to them head on?
Right.
Do you come to them from a superior position or an inferior position? Right? You got to figure that out. And so, let's say we're talking about 40 or 50 something factory workers
Gotcha.
in a different country, and
Gotcha.
I'm a 20 something kid.
Right.
Initially, I cannot come as the corporate guy in a suit, and come from above. They'll
Right.
shut me out.
Right.
I had to come from inferior and
Sure.
respect. And so once I did that, I came in, respectful, revering them, and I kind of got let in a little bit. But then I have a very small window to achieve status alignment. And so from there, you have to do a little bit of research. You got to understand the culture that you're walking into. You got to understand what they care about, what they like. And the first little bits of conversations that I had with them, I would spout off a 1 to 2 minute, just shooting the BS of something that I knew that was relevant to them. And all of a sudden, walls would come down. They're like, "Oh, you're not an outsider," and they start talking to me. And so, when someone fears pain, they recuse. They
Sure.
pull back
and they block
and
themselves
they block
off.
you
Yeah,
out.
right.
But as soon as they can exhale and put their hands down and just have a conversation,
Then you have a window.
You have a window.
Yeah.
And then you can get to know, like, and trust.
Gotcha.
Right? So only then can you start the know, like, and trust process once you've achieved status alignment. And
Nice.
the walls come down.
Now, did you actually work to change the culture in that environment, or was it just one-on-one relationships?
Sometimes it was culture change in the environment. Sometimes it was major process change, which to get people to buy in is a culture change.
Gotcha. Oh, now that makes sense. Okay, now I get it. Now I get why you were doing it. Okay, yeah, I love this because I've had some large companies that I've owned and managed, and I remember I had 60 employees doing litigation support after the crash, foreclosure defense work, and we did all sorts of things to try to generate a community culture. Remember that ice bucket challenge where people
Yes.
would, we got a dunking booth. We filled it up with ice water, and my happy ass was sitting up there first for people to dunk me in the ice water. And, we did all kinds of fun stuff to try to create community and culture, and it's just a topic I'm fascinated with. So please continue your story.
Yeah. So first of all, was your team athletic? Did you actually get dumped a few times with them?
Oh yeah. Like literally the first throw, if I recall. I'm not kidding. It was like the first. I'm like, really? Yes.
Okay, so we're picking back up where I've kind of realized that what my worth is versus what the world views my worth.
Gotcha.
Is. And I've realized that my family has had this real estate thing going on, and then when my grandfather passed away, my aunt came in and really just discovered value add, if you will. Didn't know she discovered value add, but discovered value add
in the single family space, or
in the single family.
So she was.
So this is still single.
Maybe
family.
some flipping or wholesaling or something.
Yeah.
Or what?
So,
okay.
Well, not really wholesaling. So we had the portfolio. So
right.
We diagnosed the portfolio, sold the trash, reinvested in the good stuff, increased revenues, and so it was that kind of thing.
Gotcha.
Right?
Gotcha.
And the net result was about a 3x improvement in the value and cash
No
flow
kidding.
over a year. So it was pretty fantastic. So we start researching asset classes. Go to every seminar we can imagine, and just a lot. I mean, look, success leaves clues. Like, I'm not scared to pay for education, and you shouldn't be either. You can, and you're going to pay for it one way or another. You call them seminars as well. You're either going to have your own seminars or you're going to go to some seminars. But at least you can learn things that will not end you in the business.
Okay, well, I have to say something with that comment. Thank you, and I didn't pay him to say that.
No, he
but
didn't.
you guys know I got my freaking boot camp coming up in September. DM me on any social channel, and I'll let you come for $197. It's not a big sales pitch. It's a freaking no-brainer if you're thinking about... In fact, you're crazy not to come, frankly, respectfully, if you're thinking about multifamily. It's 3 full days of training. I talk about my coaching for 30 minutes. That's the sales pitch. Not even a sales pitch. I don't try to get your money on the spot or anything.
I'm going to do one better.
Yeah.
For the first 3 people that do it, send me the bill. All right?
Really?
I believe in education that much. The
Wow.
first 3 people that DM you and do it, send me the bill for it. Because
Wow.
guys, if you are that quick to get off your butt and get some education...
There you go.
proud
There
to
you go.
support it,
There you go.
so
Okay.
anyway.
Wow. That's kind of you, buddy. Well, anyway, so yeah, you're absolutely right. And can you do it without the formal education? Yes, but you're going to have the seminars.
You're going to have seminars.
No question.
You're going to have seminars either way.
And if
by
you
the
have a
way.
big one on the first deal, there may not be a second deal.
Right.
And that's what you avoid. And in this business, correct me if I'm wrong, I mean, I know I'm not wrong, but I want them to hear it from you. It's a team sport, and you do it together, and you grow together, you build together, you play to each other's strengths, and that's how you create something magnificent. Yes?
Well, that's right. It is a team sport, and whether you hire the team, partner with the team,
right, or align, whatever. Yeah, correct.
It is a team sport,
right?
And so back to complete the story,
right,
Rod, of how we got to where we are. We figure out through research and education and all that wow, there's a big imbalance in housing supply and demand.
Mm-hmm.
We need to focus on housing. And by the way, food, water, shelter. So
that's
three
it.
basic needs
that's
of humanity.
Maslow. Yeah.
Jeff Bezos is kicking everybody's butt on food and water. So
right.
I'm gonna focus on shelter. So we decided to go into multifamily.
Mm-hmm.
Didn't know what syndicated.
And this was in 20 or when?
I bought my first property in 2019.
2019.
So every one of my four partners has been in real estate long before me. I'm the young buck. I was first involved with a piece of real estate.
Where'd you buy it? How big? What was it?
Knoxville, Tennessee.
Knoxville. Love Knoxville.
35 unit asset.
Nice.
It was built. It was a unique story. An architect lived up on a hill.
Okay.
He had a nice house, and so it was 35 units. That was one of the units.
Oh.
And he built an 8-plex about every couple of years.
Oh,
in
no
his
kidding.
backyard. It was like his retirement plan. So it was this beautifully like an architect designed it for himself. If that tells you anything.
Very cool.
So it was a maintenance dream. They were designed for being taken care of. And yeah, we bought the place with our own money. Because at that time we're just thinking about growing the family business.
Sure.
Right.
Same here. Our first one was an 88 unit with my own money too. Yeah.
Mm-hmm. And I would never encourage, unless you can't, I would never encourage you to start with someone else's money. Learn first.
Exactly.
Even if you go through all the seminars, folks, you're still going to have your own seminars.
You bet.
You'd rather do it with your own money.
Right.
So we do that, and then to get to the part where we make history is, I had partnered with two people to do this. Kim and I did.
Mm-hmm.
That was Aaron and Maurice. We bought it, decided we like working together. So very quickly, thanks to Aaron's tenacity, we quickly had 3 other properties under contract in Knoxville.
No kidding.
And the good thing about Knoxville is there was a lot of small multifamily mom and pop stuff there. We bought 7 deals in the first year in Knoxville. So within a year, we had 155 units.
Nice.
Then we went bigger.
Now, well, hold on. It may be obvious, but let's pretend it's not obvious. Why is that a big deal? What's great about what you just said?
So what I just said, we recognized that brokers weren't taking us seriously. When we tried to go bid for a 120 unit building, but we'd never bought anything other than a single family home,
right?
They wouldn't take us seriously.
Right.
And the competition was stiff, and we weren't ready to run after something.
Right.
And so we went after mom and pop buildings where it was a lot less of a stretch.
Right. Well, that's actually not what I was looking for. But what I was looking for, and I'll just say it, you created economies of scale.
That's where I was going.
Okay, you were going there. Okay,
we
good.
started there.
Okay, right.
And then we bought, but we knew 35 units is inefficient.
Right.
So we then bought 7 more.
Right.
Everything from 12 units to 35 units, all within 2
Did
miles.
you manage them, or did you vertically integrate, or were you using third party at that time?
Third party. By definition and intentionally, we will never vertically integrate.
Gotcha. Okay. All right. Fair enough. Fair enough. But same management company for all the units then?
They
okay.
operated out of an office in the basement of the architect's house on the first one.
No
That's
kidding.
How we did it.
Yeah. And what's great about that, you hear about these people that'll buy a turnkey house or a turnkey fourplex or whatever. You have absolutely no leverage. If they do a shitty job, you're screwed. I've heard about it time and time again from people that have bought a house that's 1,000 miles away, turnkey. But if you've got 100+ units, it's very significant to that management company, and you are able to leverage and get good pricing and get quality service and everything else.
Right.
And so that's where I was going, is that you're able to create economies of scale.
And that's exactly it. And then the last sentence to the story, Rod, is the beautiful thing. Everything we just talked about and learned, all you have to do is add a 0 to it to scale.
That's
right?
it.
And so from there, we just started buying bigger assets, and we started
syndicating and raising money. Right.
We discovered that the Southeastern, or the SEC, is not the Southeastern Conference. We had to learn about that, right?
That's funny.
Coming from SEC country. And so, look, that was the history. We grew from there. We've operated over 2,300 doors at this point, sold about, 400 or 500 of them at this point.
Mm-hmm.
And,
all in Tennessee?
No, everywhere from Texas to North Carolina and all the way as north as Indiana. So
no kidding. Okay, you spread out quite a bit.
Yep.
Okay, yeah, I've got assets in all those states as well. Yeah. Just for my own edification, I'm going to circle back to something for one more second, just because I can't believe you had a fairly high-level position at GE. I will tell you, if you've ever want to research an incredibly run company, it's GE. I mean, and I'll give you some examples of this. Welch wrote a book called Top Grading, where they would eliminate the bottom 10% of the people in the organization almost on an annual basis and hire better. And I mean, when he was running it, that company was like, one of the highest valued companies on the planet. And they would do, I think he implemented the 360 reviews where your subordinates review you, your superiors review you, your peers review you, and that's how they would come up with who they'd eliminate. Now, he was always one of my heroes from a business standpoint, because just such a brilliant strategist and implementer, and he really and even for a while after him, the CEOs were extraordinary. So I don't know. I didn't follow it after, when things really crashed stock-wise for GE. Yeah. I wasn't really that involved because that was more recently. But I just remember as I was learning business and everything, man, he was one of my heroes. So I just want to throw that out there. If you ever read a Jack Welch book, you will leave that book a better person and a smarter person as it relates to entrepreneurship and business.
I would agree with that wholeheartedly.
Yeah, yes. Yeah. So let's talk about. First, let's talk about where you feel we are economically in this country. I don't know if you're bearish or bullish, or even if if you're bearish, what that means to you. And I don't want to put my influence on it, so I want to hear from you what you think.
Absolutely. So that's a good conversation. I mean, look. The first thing I'll say is if you have courage and capital in a time when no one else does, you're going to do well in a time when it's scarce.
Warren Buffett, be fearful when others are greedy.
Yes.
It's been a lot of greed the last couple of years, but the other side of that is be greedy when others are fearful. And fear is coming, yes?
Fear is coming. Yeah. It's already here.
It's already here.
But the pain isn't all the way here yet.
Right.
Pain. Like I heard a great analogy. Actually, my partner said this. The economic turmoil we're in it's been coming like a slow-moving iceberg. It's been slow and not noticeable.
Oh, that's
Once
good.
it starts to hit, it is devastating.
That's really good. And I will tell you, like we wrote an LOI yesterday on a deal, and I had a conversation with my team, and I'm like, why are they selling? This is the worst possible time to sell. And sure as shit, they got 3 months before their loan resets, and they're in deep doo-doo. And I told my team, right now, surety of close is everything. Okay, price is not as important as your ability to close. And so I don't know what that looks like, but that's something we're evaluating heavily because it's very dangerous right now not to have a financing contingency in your contract. And raising money is much harder right now. Investors are scared. They shouldn't be because there's going to be incredible opportunity, but they are. Okay, and the banks are paying some decent interest rates right now. So there's headwinds for acquiring property. So speak to how you plan to navigate this environment and what you think may be coming. I'm sorry, I kind of stole your thunder.
No, that's the great conversation. And look, I mean, we've been talking about inflation. We've been talking about rising interest rates. We've been talking about why that is. I'm not going to go into that. And, simply put, you inject however many $1 trillion into the money system. Well, of course, you diluted it. It's going to eventually come back. So all we're having is economic long COVID, right? The results of what we did in 2020 are happening now. So here we are. Interest rates have risen at a rate faster than they have since the late 70s.
22-year high as of yesterday.
Yep.
Highest interest rate in 22 years as of yesterday.
Which, by the way, in the history of interest rates, it's still not that bad.
Oh, it's not. Dude, when I started in this business, interest rates were 18%.
Yeah.
Okay? Yeah. I remember freaking out when they hit 7%. I'm like, holy shit, they're 7%. And so yeah, you're right. Historically, they're not high.
And I remember originating a loan at 4.75% and being pissed to high heaven about it. So it's like it's all perspective.
Right.
But look, here's what's happening. Okay, lenders are not. They have not forgotten 2008. And so what you're seeing, especially regulated lenders like banks, they're not being so quick. They'll be really hard on you until you try to hand the keys back. And just watch the office sector. They've been really hard on people trying to get the money to be paid, even though these things are negative cash flowing. There's been some big organizations who finally said,
here's the keys. Big hotel chains, big office.
Wait a minute. We don't want the keys back. No,
right.
So it's that kind of situation. Lenders are going to be more apt to renegotiate loans and do workouts.
If they can.
If they can.
And depending upon, the wherewithal of the borrowers. In fact, the Fed just put out I don't know if it's the Fed.
It was the Fed.
It was the Fed. They put out an announcement to lending institutions saying, work with borrowers if they're still creditworthy. But that said, a third of all commercial debt is with small and regional banks.
Yes.
And I got to tell you, I think we're going to see some bank failures, dude.
Well, it's already happening.
Yeah, I mean, we have, but I mean more. Yeah. I think it's
already happening.
Yeah.
And remember, the banks are in a really bad place. We try to think about and focus on what the news talks about, and that's interest rates. That's only half the equation.
Right.
Liquidity is the other part of the equation. And the Fed has been not only raising interest rates, but sucking liquidity out of the market, which means banks don't have the liquidity that they need.
It's called quantitative tightening.
Tightening,
right.
Opposite of easing.
Right.
And so where are we today? Look, if you're highly leveraged on an asset or you have a bridge loan coming due, be proactive. Because the number one thing that the worst thing you can do is just hope the situation works out.
Hope the interest rate gets lower. Hope somebody buys your asset and pays you top dollar. I mean, we're seeing that. Yeah. There's still that price, discussion.
Price discovery.
Yeah, discovery. They call it price discovery when they try to find out what they can get for an asset. And even the brokers are still unrealistic. I think it's all going to change. But like you said, the big thing is going to be the capital stack. It's going to be it's going to be the debt and the equity. And like right now, we're looking at an asset that's a screaming deal, but the debt is 50%. That's all we can get.
Yes.
50% debt. And
floating rate stuff is out right now.
Do not do floating rate. Jesus, I mean, you
can't even cap it. It's like 6%.
I when we were at was it IMN where we ran into each other? Yeah, so IMN mid market, and there were lenders there, and they were like, yeah, we can do a fixed rate bridge for you. Really, what rate? 9? Like, okay, come on.
By the way, folks, all that means is they bake in the hedging product for you.
Oh, sure. They're already baked in the interest rate rises. I tell the story. I read an article, I forgot where it was, and it's been like 4 or 5 months ago, where in 2020 you could get a rate cap of $100 million, 3 years, 3% rate cap. Okay, so that means the rate's not going to go up more than 3% over a 3-year period. $100 million was $23,000.
Yeah.
That same
it was
rate
a line item, folks. You never thought about it.
Yeah, that same rate cap. I mean, this was 4 or 5 months ago. I think it's more than that now. For 1 year, forget 3 years. You'd never get 3 years. Was $2.3 million.
Yeah.
And I'm like, these guys like this deal that we're looking at where the loan's resetting. Not only do they have to deal with that rate cap, but I'm sure that their debt service coverage ratio is not sufficient either. So, guys, in the commercial real estate space, the lender's looking at the property's ability to service the debt. It's called a debt service coverage ratio. And, and I'll give you just a quick example of this if you've never heard this. Let me give you an example. It's an annual calculation. Let's say the net income on a property, the NOI, net operating income, is $125,000 for the year. Let's say the debt annualized for the whole year is $100,000. So $125,000 income, $100,000 debt. That's a 1.25% debt service coverage ratio. And that's pretty much a minimum for most lending institutions. Well, if the interest rate's gone up, I mean, I've seen some of these bridge deals where they're negative. I mean, they're under 1%, many of them, and so they're going to have to funnel money into the deal to get that debt service coverage reasonable and pay the rate cap. I was talking to my SEC attorney, the one I use the most, a brilliant, smart guy, big firm out of Dallas, and he told me half his business now is capital calls to investors, forbearances and foreclosures. Half his business right now. Sad. Yeah, and it's coming. That's just the tip.
Folks, I want to give you a seminar real quick, right?
Yeah.
To use your language. So let's just talk about bridge debt for a second.
Right.
All right, and because I'm going to tell you what I've felt. If you know Quattro, we do not do risky deals. We don't do high leverage deals.
Yeah, same
at
here.
Most on a bridge loan, I'm leveraged 70% loan to cost at most, right?
You have some bridge debt right now?
I do.
You do.
But here's the deal. Like so we were smart when we took it, okay? And I was buying 1% rate caps before it was cool. People thought I was an idiot, but who's laughing now? My rate could only go above the spread 1%. 1%. So the way they do bridge loans, folks, is you have a spread over an index, and that index moves. So maybe it's SOFR, it used to be LIBOR, but it doesn't matter. Just know that there's an index that moves, and you're going to pay a spread over that index as it moves. Well, you can buy, since maybe 2 years ago, that index was almost 0. Well, now it's like 5.3 at the peak. So if you didn't cap your loan and you had, let's say, a 300-point spread, you're now paying 8% where you thought you were paying 3.
300 points would be 300, what he's talking about is basis points
Yes.
would be 3% interest, okay?
Yes, thank you for that. And so here's the seminar. We cap that rate. So I bought a 1% rate cap, which means if I had a 300 basis point spread, 3%, I'm only paying 4. Fine, that's great. Well, here's the deal. When the banks get into trouble, and oh, by the way, these bridge lenders and debt funds, they've all got banks behind them. They don't have all the money sitting right there. Well, when Signature Bank got in trouble, for example, they started scrutinizing everything the bridge lenders were doing. And guess what? You have covenants in that loan. Even if you can service the debt fine with your rate cap, they're still checking debt service coverage ratio, and they're looking at exit valuations periodically. So if they believe, this could have nothing to do with what you're doing on the property.
Right.
If they believe that they don't want to put more money into that loan, they have ways to stop funding your draws. And here's the biggest seminar that I've learned, which has put me into about a $5 million problem I've had to solve, which we've solved. But the problem is, if you're counting on construction money coming from a lender in a time like this, they used to take 1 to 2 weeks to fund those. Now they're taking 2 to 4 months if they fund it.
No kidding.
Okay, and so you have to remember that, in the bridge debt world, there are so many things out of your control. It's just not worth it.
The lending documents for bridge loans are very onerous, and
not in your favor, by the way.
No, not at all. And they also look at performance, not just performance on the debt service coverage piece, but on your occupancy, on your ability to do your renovations on schedule as you agreed to. And
it's a tightrope.
I will tell you, it's a nefarious tightrope in some cases, and there's a nefarious component in some cases. I mean, I like to equate bridge debt to the hard money lenders of the residential space. I think there's a comparison there. I'll give you a crazy example. One of my students, one of my warriors, he had gotten approved for a bridge loan, and like a day or two before closing, they backed out.
Sounds about right.
Well, okay, now listen, it gets better. That bridge lender bought that asset. Oh yeah, now he took him to court and won, but that's the kind of stuff that can happen. And now there are a lot of big, very reputable bridge lenders, but I'll tell you, by the way, when is your debt coming due?
Oh, I've still got years on that.
Oh, you
so
do? Okay.
I'm good
all right. Good.
But here's the problem, folks. And so, like, the only way we agreed to do bridge debt was you only get in trouble in real estate if you have two things happen. Just two. It all boils down to two. You run out of time or you run out of money.
Yeah.
Okay. And so we wanted to make sure we're not going to run out of time. So these bridge loans are 5 years. Okay.
Good.
And we're not going to run out of money.
311.
311.
Right.
And we negotiated the extensions heavily. So it
you
doesn't
did.
take much to get into.
Oh, that's good. So what I meant by 311 is you get a 3-year term and then you get 2 1-year extensions. Okay.
That you have to qualify for.
And you have to qualify for those extensions, and you likely are going to pay additional fees to get those extensions. So you negotiated those in advance.
The mess out of those.
Okay, well that's great. Yeah, we've got a couple of bridge loans with my ex-partner, and we're good friends and all that, and we're monitoring it literally on a monthly basis. But we're going to be fine. But these two most recent deals I've done I've only done 2 deals in the last 18 months. 296 unit and that 145 in Nashville, 10-year fixed rate debt. I mean, and these were both 60% loan to value. And they were 50-50 deals on the back end. That's how good they were. Okay, they weren't like, guys. When you do a multifamily deal, you're going to offer a preferred return to the investors, and we do like an 8 pref. It's called a pref, and then you split anything over and above that. And you'll see splits from 50-50 to 80-20, and even in some extreme examples, 90-10 from a competitor of mine. I couldn't believe he allowed his students to do that. But the higher that split, the skinnier the deal, because the operator has to adjust the split to get the returns that his investors need to have the deals make sense. And like I said, the average is probably 70-30, but these last 2 deals we did were 50-50 because they were that good. Now, I will tell you the deal we're looking at right now is a 70-30 as well, but it's an A-class asset, and that's
a standard split.
Yeah, it's a standard split, but debt is a big deal right now, and it's challenging right now, and that's why we talked about a financing contingency. I mean, I'd think you'd be crazy to let money go hard with that one. Are
Absolutely.
Are we in agreement? Yeah. Okay.
And I've been there. Ask me
Right.
how I know.
Right.
You know?
Ask me how. That's funny you say that. And did I tell you that on my interview with you?
No, you didn't.
Okay.
You have one
So
too?
at my boot camp, I say, don't do that. Ask me how I know. And so one of my students actually got me a hashtag Ask Me How I Know t-shirt. True story. And now we have them printed and we give them away there. It's a riot. But it's just funny you said that. So how are you looking to structure deals today?
Yeah, so the way I'm doing it today, as you mentioned, I'm not touching anything with a floater on it.
Right. Forget it.
It's just cost prohibitive.
It's insane.
It's cost prohibitive.
Right.
And oh, by the way, I had to hire 4 people to do draw requests, so it's a way. You're not really saving any money on this.
Wow.
Just
No
don't do it.
kidding.
That's
What
how
a
detailed the
pain in the
requests
ass.
are.
Wow.
So anyway, pain in the neck. Don't do bridge debt. I love credit unions. If you can get down with recourse or partial recourse, credit unions offer a very great structure. 10-year term, no prepay, couple years IO, and it rolls to perm. That's
what
good.
debt size? What loan size?
I'd say up to $15 million. Probably not anything much bigger than that.
Okay. Wow.
They will syndicate amongst themselves if it's bigger. But
Okay.
The main tool that I'm using.
And what loan to value typically?
They're probably going to get you to 70% best case.
Yeah,
But
best case.
Today
Probably
it's more
60,
like
65.
50 to 60.
50
Yeah,
to 60.
today.
Okay.
Folks, everything is DSCR constrained right now.
Right.
Everything. It doesn't matter if they say they'll do 70%, 75% LTV. Nothing pencils there.
DSCR, again, is that debt service coverage ratio that we talked about, that 1.25, you know?
Everything is getting, so they always test LTV based on appraisal, loan to value, or they'll test debt coverage ratio. And whichever one you butt up against, that's what limits.
The lower of the two.
The lower of the two. And
Correct.
right now it's debt coverage ratio that
Correct.
limits things. So,
Correct.
Look, the best product in my opinion right now, and this is subjective, so take it for what it's worth. I love agency debt.
Right.
What I am doing is I am using, to as much as I can, 5-year fixed rate debt. And here's why I'm doing that in over 10. There for a couple of months, the 5, 7, and 10-year treasuries were all on top of each other, so this really made sense. Now they've spread out, so you have to think about it a little bit, because the 10-year yield is usually lower, meaning you get a lower rate. But what I like about the 5-year fixed product is I don't do small balance loans, because you usually can't put supplementals on those later if you want to pull more cash out.
So what he's talking about, with Fannie and Freddie, you can do what's called a supplemental loan, and it's a second mortgage, but it's unique in the fact that it really ties into the first mortgage, and they match the term. And it's how, seasoned operators will pull money out of a deal rather than refinancing the entire underlying debt. Because when you get Fannie and Freddie debt, you've got stiff prepayment penalties. They're called yield maintenance and defeasance. Thank you, and defeasance. And so what you do, so you don't pay off that underlying loan and pay those heavy fees, is you get a supplemental loan. So I just wanted to describe that real quick.
Yeah, cut me off anytime we need to have a segue like
right.
that. And so here's the thing, because if you get the opportunity for a supplemental, then you don't have to worry about the prepayment if you want to keep the asset. And what I don't know much, but what I do know is if you study the history of the Federal Reserve, just go pull up on Fred.com and plot the Treasury rates since the beginning of time, okay? You're going to see, and you can overlay recessions with it. Whether you guys think we are or not, we're in one, okay? Industries are feeling it. So we're on a recession. From the history shows, from the first rate hike is 2 years average, the first rate cut comes. We're on the clock since beginning of 22, okay? We're now in mid-2023.
So the average has been 2 years when they start dropping the rates again.
2 years, max of 3.
Okay.
So we're in.
Could be 3 years.
Could be 3.
So that would be when?
24 to 25.
Right.
Is really when we're expecting.
I don't think we're going to see rate drops before 24.
I don't think we can at this point. But here's the problem. If you go lock in, let's just say rates are 7% right now, and actually on a 10-year Treasury based rate for Fannie and Freddie agency debt, it is about 6.25, give or take.
Yeah, we did our last one at 5.4. Yeah,
it's up now. So if you lock that in right now for 10 years, you're going to be kicking yourself.
If it drops back to 3 or 4, sure.
Right, 5 years from now.
Right.
Because it will drop some. It probably won't go to 3, but it will drop some.
I'm just such a bear. I'm worried that it could be bigger than we think it could be. But,
Well, and that's your experience.
Yeah.
Because perspective, back in your day, you've seen it.
I did. And that's why, 5-year debt scares me right now. I'll be candid. And I hope I'm wrong. And I probably am. My kids love to tell me, you tired of being wrong?
5 years is a long time.
Yeah.
But and these are opinions we're talking about. So right. I'm bullish on the rates resetting the other direction.
Yeah.
But
just remember,
I do not think
at one point they went to 18.
They did.
Okay.
They did.
God help us, but we won't go political. But I will say this. Love him or hate him, Trump said it could be as bad as the Great Depression. That's a quote, a direct quote from a speech he gave. Elon Musk said, they're lying to you. It's going to be a much bigger crash. Both pretty smart guys. Musk, I think
Elon's a soft landing is out of the question.
I agree. I agree, man. I think it's going to be ugly, and there's going to be incredible freaking opportunity.
Yes.
So don't get scared.
Remember why do they raise rates? Right?
Well, they think they're stopping inflation,
right?
But the inflation is because the morons printed so much freaking money.
But think about this. We're already breaking glass in the banking system.
Right.
So if we punch through and go to 10%, we're going to shatter it. Right. So here's what's likely to happen. I mean, and I'm not scared to predict and be wrong, but what's likely to happen is we're going to push a little too far. We're going to break more glass, and we're going to have to cut rates. In which case, we're going to be having the same damn conversation 4 years from now when inflation picks back up because we printed more money to stimulate. So I think we're in for a ride the next several years.
But here's some other things that I've talked about previously, so forgive me if you guys have heard it already. This is like 6 months ago, I saw an article. There are 20 million families behind on their utility bills right now. 20 million families.
Where'd you see that stat?
I've got it right here behind me. Hold on.
Yeah.
I've got it on the floor here. Forbes, I don't have the date on this, expect layoffs at 51% of the U.S. companies, according to new survey. Okay, hold on. Warren Buffett preparing for a market downturn, not as here we go. This was from, I don't have that, it's Economy either magazine or a website, more than 20 million U.S. households behind on their utility bills.
Wow, that's a stat I had not seen.
Here's Elon Musk. Everyone's lying. A bigger crash is coming.
Yes, I've seen that one.
Yeah. But even like in this Forbes, the top office markets from San Francisco to New York to Phoenix to Dallas are at the low 70% occupancy.
Yeah.
They aren't breaking even.
That's right.
And so
it's a fundamental change in the supply. Or the
right.
demand.
But that debt is in default.
Yes.
And we're talking almost all of it in most of these offices. And that debt is a third of it's with small and regional banks, and that's my concern. I think the bank failures are coming, and I think they could be the catalyst for something bigger. Again, I'm not trying to scare you. I'm just trying to tell you, I believe everything's going on sale. I think there's going to be incredible opportunities. I think there's going to be
starting to happen.
Right. And we're going to see businesses go on sale. There's 80 million baby boomers. A lot of them have businesses they want to sell. There's going to be opportunity there, something I'm interested in as well. But asset classes in real estate, I think they're all going to have opportunity. Single family, you can buy deals if you want. I highly encourage you to do multi instead. But even, other asset classes, stay the hell away from office, and maybe even stay away from retail, candidly. But I don't know what your thoughts are on other asset classes. Do you even mess with them at all?
Well, I do. We watch everything.
Okay.
And I'm going to quote the Linneman letter here. This is an economist, Dr. Peter Linneman, I love to follow. He has a very pragmatic approach to the economic things here. And so, one thing that comes out of that is it's interesting. I want to research that stat a little bit because the numbers I've seen as well.
Oh, sorry. I remembered what the other thing was. Forgive me. But finish your thought, and then I'll tell you what it was. Okay.
The numbers that I've seen are the consumer, on average, is actually in a much stronger position than they've ever been. And think about why. About 60% of consumers own a home. About 45% of that has actually locked in a sub 3% interest rate.
Oh, yeah.
No,
I read that today, actually. Yes. I read that on CRE Connect today.
Which equates to about $7,000 a year more of spending power in their pocket.
Right. It's I literally just read that today because a lot of these people got these very low interest rate loans, so they have more purchasing power. But here's the thing, I think it's really the demographic. Okay, this is why I'm not going to touch a C-class asset right now because there is a demographic that is getting their asses handed to them right now,
and that is the lower
I
end
think
of the
that's
spectrum.
the 20 million households that are in trouble. The other statistic, and I got to find the article, is that
that's the behind on utility bills.
That's correct. That's what I'm talking
now
about.
I'm seeing the population
And a lot of people are using credit cards to pay ordinary expenses. What's wrong with that picture, right? And so,
Music stops.
Thank you. And so, I want to be an optimist, but I'm being an optimist. Honestly, my rose-colored glasses are looking for opportunity. In 2008 and 2009, I got my ass handed to me. This time, I like to say I got crushed by that wave. I'm surfing this wave.
And let's talk about how to capitalize on that in just a
Let's
second.
do it.
After I talk about the different asset classes.
Okay.
So I think, if you're a developer at all and you're developing apartments, I think there's a big wave of deliveries right now that started in 2020, but there's still that imbalance. You still have opportunity to build, and by the time you start drawing on your loan, you're probably going to be in pretty good shape. I think, like you, there's a lot of dumb money and acquisitions that were done in the last couple of years, and that reckoning is coming. So
wet behind the ears operators. They've never been through a downturn. They don't know how to effectively asset manage. They don't know. They're terrified. They've got adjustable rate debt, or I just saw. Of course, you saw the big foreclosure article in Houston. One of my competitors' students got creamed 3,300 foreclosure units, 100, like 100 million in lost investor equity. But they just did another article in Real Page about some big investors. One of them even attended my mastermind with 20,000 units, and he's in big trouble. And another kid, I went to his meetup in Phoenix, he's in big trouble. They all have these adjustable rate debt loans that aren't breaking even. And so, I like I say, I think, but anyway, continue.
And not, to the terrified nature of this. I mean, I'm very grateful that I have veterans on my team who've seen this before and been through a downturn. I would be terrified as well had I not seen this.
Right.
And I'm not going to lie, it's still a little scary.
Right.
But looking at other asset classes, I mean, if you're the type who can repurpose here's what's going to happen. When we renormalize to office occupancy, it's not going to be where it was.
Oh, no. People are going to stay at home. Right. So, if you can figure out how to repurpose office.
The older stuff, because the A-class office is what'll succeed.
Right.
The older stuff is not. So, if you can repurpose
self-storage, multifamily.
Self-storage, I'd stay away from right now.
No, I'm saying you could repurpose to self-storage, smaller office buildings. But repurposing to multi, there has to be some pieces. It's huge. There have to be some pieces in place.
If you know what you're doing.
Right. But
the other asset classes, self-storage, the rates are so fluctuating.
Yeah,
right
they're
now.
dropping right now. I'm hearing some pain in that environment.
I was on the phone with, they were asking 185 this time last year. They're down to 125. Good news is he bought this thing for 10 cents.
The guy I'm interviewing right after you is in self-storage, so I'm gonna hold his feet to the fire and find out what's going on. Yeah.
I still think mobile home parks are great, but if you have a position in retail, I'd hold it. I wouldn't buy more right now because if we're going into what we think we're going into, retail will get hit.
Retail will get hit, and then that doesn't even take into account the Amazon dynamic, which is not just Amazon anymore. Right. I mean, I buy stuff on Walmart. I bought safes from Walmart and Home Depot and all online. And
tell me why you guys think Bed Bath & Beyond and Toys R Us and Babies R Us have went under.
And Radio Shack. Yeah.
All that happened was their suppliers went straight to market.
Right.
They can sell it online now.
Right.
Undercut the store.
Thank you.
That's what happened.
Right. And I mean, there will still be some retail fitness centers and things that hair salons and restaurants and things that will be okay. But the people that are selling goods, that's when it's challenging. That's when even the pet supply stores could face challenges. So, I'd be very, very careful with retail right now. But I love mobile home parks. I freaking love them. I mean, because they won't make any more of them. It's the lowest, cost to a resident. We
can end it there. I mean, personally, I'm not a big square footage guy, so I don't really do
industrial
warehouse or anything like that.
I mean, that market's done really well because of the Amazon dynamic. Right. Correct. With what's coming, we know there's pain coming. We know there's incredible opportunity coming. I could be exponential opportunity. Could be the greatest transfer of wealth literally we see in our lifetimes. Who knows? Yes. We'll see. Grant Cardone calls it Armageddon. Okay, I think it's going to be bad as well. Bad. So how do you capitalize? How do you take advantage of what's coming?
Folks, you have to be ready. And what I mean by ready is luck is where preparation meets opportunity. So if you're not prepared, you're not educated, then make it happen, get it done, because you need to be ready to capitalize on the opportunity.
Boot camp. No.
Yes, exactly. And so the second part of that is, and I said it earlier, to capitalize in a market where everyone else is scared, you have to have courage and capital when others are fearful. Mm-hmm. And the big part of that is capital. Mm-hmm. So how do you do that? If you think you're going to go put something under contract and raise money in a hurry, you may do that, but it's going to be hard. I would recommend Get your tail into a fund. Figure out how to launch some kind of a distressed asset fund. Get the money raised, okay? Make it very clear, folks, we're preparing for Armageddon, and we need to be ready to scoop it up. We're not going to start cash flowing in 2 months, so don't even ask the question, you know? But if you're in a position with your investors to get that fund in place and be ready to jump, because what's going to, and you said it earlier, the way you're going to get these deals for 40 and 50 cents on the dollar, I've bought them this way.
Right.
You have to have certainty of close, which means you show cash in the bank, and then your negotiating power will be through the roof. And when you buy that, the market will normalize at some point.
Sure it will.
And you're going to be in
Sure
great
it will.
shape.
Yeah, we're doing literally, I know you're doing a fund. We're doing a fund right now. We're going to launch it here in a week as well. I think yours is coming up in a week. And we're getting ready. Preparation meets opportunity. I love it. I'd forgotten that quote. It's an awesome quote. And that is going to be what happens. So let me ask you a question. Let me ask you a couple of questions that are a little more mindset related.
Let's do it.
You know, you're a real motivated guy. You're into Tony like I am, and love self-actualization and becoming everything you can possibly be. What's your why? What makes you jump out of bed and make this happen and fly down here just to sit and suffer through an interview with me?
You know, I have two things. Once I discovered that I was worth more than I was being paid, folks, I made sure that I'd be in control of my own destiny. You think you're safe at that job? You're only 2 weeks away from termination. Okay,
Yeah.
2-week notice.
Yeah.
Period. And I like being in control, and I love what the 5 freedoms that I live by. You know, let's see if I can get this right. I miss them sometimes.
Time.
But it's first it's freedom of finance,
Finance.
which gives you freedom of time, which leads to freedom of relationship, freedom of passion, and freedom of geography. Okay, like those 5 freedoms I live for, and I want that balance in my life. And so that's why I do this, because now, like you said, I traveled down here for this. All I have to have is my iPhone and my MacBook, and I can run my enterprise from anywhere in the world.
It's a beautiful thing about this business, man.
It's wonderful. And you know what? Like I'm present for every childhood event my kids have. I'm present with my family. Like that is why I do this personally. But here's the other side. And this developed as I was starting this. I have taken over some of the saddest buildings that you have seen early in my career, and the things that some of these families are living in, it pisses me off.
Yeah, same here.
This is allowed.
Same here.
And so not only do we fix that, but I have set out on a mission to eradicate generational poverty from this world, and that whole thing
that's
pisses
cool.
me off. And here's how we're going to do it. Like, it's still unfolding. We've got the Quattro Giving Fund live, which is where we actually put money to work in this arena. But look, the nexus of it is, it has to skip a generation, Rod. Sometimes you can stabilize a household, provide food, provide water, provide shelter, provide opportunity and education. You can't always change the old dog. It's hard to teach an old dog new tricks, right? But if you can provide that for a child, you know, and stabilize the family to benefit the child, as long as you can look at it as long-term return, I really think more is possible than what we're
like
doing.
it.
So
I like it.
That's a
I love
why
it.
that
I love it.
have,
Yeah, we're doing, my charity, we're doing 1,700 or 1,800 backpacks in 2 weeks. Yeah, we've done
schools, back to school.
like tens of thousands. Yeah. And we feed families for the holidays as well. We've somewhere between 130 and 140,000 kids in the last 23 years. Got that from Tony, actually, his basket brigade.
I have a vision at some point to actually buy buildings that are purposed for this. They're not profit centers, they're cost centers.
Nice.
Right? They're just for, stabilizing families.
No, I love it. Oh, I love it. I love it. Yeah, I my ultimate vision is to build schools, self-sustaining schools, where there's a maybe an agricultural infrastructure. You buy enough land to have an ag or a tech infrastructure. You put in a computer room, and it's able to actually sustain itself. It doesn't need to be fed. That's a dream of mine. But well, listen, brother, this has been a lot of fun. It's great to see you again, and. Guys, check out his podcast, Real Estate Runway, and I appreciate you coming in, my friend.
Yeah, folks, and look, if you want to reach out, talk to me more, I'm happy to share. ChadSutton.info. That's all you need.
ChadSutton.info. Okay, got it. Thank you. It's good to see you, bud. Thank you.
As well.
So one other quick thing. We encounter so many people that are, frankly, frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. But see, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.